Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at BigBear.ai.
If you find our talks useful, please consider subscribe, like, and comment underneath.
It's good to be here.
You know, usually when we sit down to talk about a stock, we can sort of ease into it, talk about the industry, maybe the leadership. But today, I feel like we just have to jump right into the chaos. Because if you've pulled up the chart for BigBear.ai recently, you might be feeling a little bit of whiplash.
Whiplash is a good word for it. It has been an incredibly volatile ride.
Volatile. It's been a roller coaster without a safety bar. I mean, let's just look back a few months. October 2025, the stock went absolutely parabolic.
Up 76%.
76%. People were calling it the next big AI play. And then, then gravity showed up.
It did. And it hit hard. Coming into February 2026, we just saw the floor fall out, a sharp 36% plummet.
Which is terrifying. If you're an average investor, you see that much red, and your first instinct is to hit the sell button. So the big question is, what is this?
Right.
Is this a falling knife we shouldn't touch? Or is this actually a gift? A golden opportunity to buy the dip before a huge turnaround?
And that is the multi-million-dollar question. And honestly, if you're just looking at the red and green candles on the chart, you're going to get the wrong answer.
You have to look deeper.
You have to look past the price action and actually open the hood of the business. Because the story underneath, it's changing in ways that the chart hasn't fully caught up to yet.
Okay, let's pop the hood then. Let's start with the basics. Identity. When I hear a name like BigBear.ai, my brain immediately goes to the hype train.
Sure.
I'm thinking, some hot startup that launched 6 months ago in a garage in San Francisco. Is that what this is?
Not even close. And that's probably the biggest misconception about this company. Big Bear isn't just riding the latest generative AI wave.
So they're not trying to be the next ChatGPT.
No, not at all. They have domain expertise that dates all the way back to 1988.
1988, that's pre-internet for most people.
Exactly. Their core business is something called decision intelligence.
Decision intelligence. Okay, that sounds impressive, but let's unpack that. What does that actually mean?
Well, think about high-stakes environments. We're not talking about optimizing ad clicks here. We're talking about the U.S. intelligence community, the Department of Defense, border security.
Places where getting it wrong has serious consequences.
Catastrophic consequences. These are places where humans have to make life or death choices based on huge amounts of messy, incomplete data. Big Bear's tech doesn't just show you a chart, it helps predict outcomes.
So it's less like a research assistant and more like a grandmaster chess player whispering in your ear.
That's a great analogy. It's about providing foresight. And that's what makes the business so sticky.
Stickiness, love that word. It means it's hard to get rid of them.
Precisely. This is their moat. If you're the Pentagon and Big Bear's predictive analytics are woven into your mission-critical workflow, you can't just rip them out.
It's not just software at that point, it's infrastructure.
Exactly. The switching costs are massive, retraining personnel, new security clearances, migrating petabytes of data. It's a nightmare. A new startup can't just come in and compete no matter how cool their tech looks.
So this is where the comparison to Palantir comes in, right?
Yeah.
Because they're the 800-pound gorilla in this space.
They are, but they're different beasts. Palantir wants to be the broad data operating system for everyone.
The general contractor.
Right. Big Bear is more the specialist. They're the subject matter experts you call for very specific things, like homeland security or manufacturing logistics. They go deep where others go wide.
Okay, so the story sounds great. Deep roots, sticky government clients.
Yeah.
But, and there's always a but, I looked at the financials, and I have to be honest, it's confusing. There's a huge conflict between the top line and the bottom line.
It's a tale of two cities, financially. A very stark contrast.
Let's start with the good news. Soften the blow a bit. What's working?
The revenue is real. This isn't some pre-revenue pipe dream. Their trailing 12-month revenue is a solid $144.2 million.
Okay.
And importantly, the gross profit is just under $40 million.
So a gross margin around 27%. That's decent. It shows they aren't just selling dollar bills for 90 cents. There's real demand.
Correct. But then you scroll down to the bottom line, and that's where the ugly reality hits.
How ugly are we talking?
The net loss is massive. Trailing 12-month earnings are negative $426 million.
Whoa, hold on. Negative $400 million on $140 million in revenue. How is that math even possible? Are they just lighting money on fire?
It feels like it, doesn't it? The net margin is a staggering negative 295%. But it's less about burning money and more about the cost of building a very, very expensive machine.
So where's it all going?
A lot of it is in other expenses, over $465 million. It just reflects the insane operational intensity you need to scale AI in these secure government environments.
Operational intensity. What does that mean in plain English?
It means you need staff with top-secret security clearances, which costs a fortune to get and maintain. You need specialized hardware. You need to constantly tune the models. It is incredibly expensive just to have a seat at this table.
So they're spending heavily just to be able to compete. But with a burn rate like that, I have to ask, are they going to go bankrupt?
Surprisingly, no. And this is the paradox. Despite those terrifying losses, their financial health score is a 6 out of 6. Perfect score.
How's that possible? A 6 out of 6 with that much red ink?
It comes down to the balance sheet. They've been very smart with debt. Their debt-to-equity ratio is only about 17%.
That's incredibly low for a company like this.
It is. And they're not doing dividends or buybacks. Every single cent is being reinvested back into the AI portfolio, autonomous systems, cyber supply chains. They're feeding the beast to grow it.
Okay, so the argument is they have enough cash to survive the burn until the revenue catches up.
That's the entire turnaround narrative. You don't buy this stock for what they lost in 2025. You buy it for what they might earn in 2026.
The future promises.
Exactly. The whole bull case rests on the contract catalyst.
Okay, let's get specific then. Promises are cheap. What ink is on paper?
There's quite a bit. You've got Vane, J35, Seaport. These are major government contracts. But the one that really turned heads is the Ask Sage deal.
Ask Sage, I've heard that name. What's the number attached to it?
$250 million.
$250 million. That's
No.
almost double their entire revenue from last year.
It is. And that's why the narrative is shifting. These contracts are the bridge from today's losses to tomorrow's potential revenue acceleration. If the government starts cutting checks against that $250 million, that ugly earnings report starts to look very different very fast.
And they're diversifying too, right? It's not just one client.
That's a key point. They've made strategic acquisitions in border security. You never want to be reliant on just one agency's budget in government contracting.
Because if that budget gets cut, you're done for.
Precisely. This diversification makes the whole thing more stable.
Okay, so the fundamentals are complicated but promising. Let's talk about the market psychology. We started this whole talk about that 36% drop.
The price action context.
Yeah, the chart as of early February 2026 looks pretty ugly.
It does, but you have to zoom out. Remember that 76% rally that came right before it? When a stock goes vertical like that, profit-taking is just inevitable.
So this drop is just people cashing out.
I see it less as a disaster and more as psychological consolidation.
Psychological consolidation. That sounds like a term from therapy.
Well, the market is kind of like therapy. It's processing emotion. The market got ahead of itself, betting on what we call speculative exposure.
Meaning people are just buying the idea of AI.
Exactly. When the AI narrative is hot, money just floods into anything with AI in its name. When sentiment cools, that money leaves just as fast. Big Bear is a high beta stock, so it moves with that tide.
But the mood does feel like it's shifting again, doesn't it? Just in January, the headlines started to sound different.
They absolutely did. We saw a clear sentiment shift from skepticism, can they survive, to bullishness.
So look at this upside.
Exactly.
Yeah.
Analysts started issuing upgrades. They see the Ask Sage deal and the border security work and realize this isn't a one-trick pony anymore. The narrative is moving from survival to growth.
It's always a feedback loop, isn't it? The price follows the narrative follows the price.
It is. And while we haven't seen any massive insider buys yet, you can infer the institutional interest is picking up. The big money is sniffing around defense AI.
Which, unfortunately, seems like a sector that's only going to grow.
That's the reality. Global security demands are rising.
Okay, before we get too optimistic, I need you to be the pessimist. Put on your bear suit, pun intended. What could go wrong here?
The cold water reality. It's important.
Give me risk number one.
Persistent losses. We can't just ignore that $426 million hole if those big government contracts get delayed.
Which happens all the time with government work.
All the time. Bureaucracy moves slowly. If those payouts get pushed back even 6 months, that cash burn becomes a huge liability.
So time is the enemy.
Time is literally money here. Risk number two is valuation. By any standard quantitative model, their growth and performance scores are low, like 0 out of 6 low.
Ouch.
This is not a blue chip safety stock. This isn't Coca-Cola. It is a speculative play on a future that hasn't happened yet.
And risk number 3.
The volatility, that 36% drop. If you're an investor who loses sleep when your portfolio is down 5%, this stock is not for you. You need a strong stomach.
Don't invest your rent money.
Absolutely not. This is risk capital only.
Okay, we know the risks. So what should we be watching for? What are the key dates to circle on the calendar?
The most immediate one is February 18th, 2026.
What's happening then?
A special meeting of stockholders.
Sounds exciting.
I know, governance isn't sexy, but in a turnaround story, these meetings matter. They can signal big changes. It's a date to watch.
And after that?
The big one is Q4 earnings, coming in the spring. That's the litmus test. The market will want to see if that defense revenue is actually hitting the books.
Show me the money.
Exactly. And on the macro level, just watch the sector rotation. We're seeing big money move out of consumer tech and into defense and AI security.
The world is getting scarier.
And Big Bear sits right at that intersection. AI plus defense. A rising tide there could lift their boat.
Okay, we've covered the tech, the scary financials, the big contracts, the risks. It's time. The verdict. Scale of 1 to 10, where do you land?
I'm giving this a bullish score of 7 out of 10.
A 7. That's pretty confident, given the red flags we just discussed.
It is. But here's the elevator pitch. BigBear.ai is at a pivot point. It's a high-upside AI play that is cemented by a very strong defense moat.
That moat is key.
It's everything. The barrier to entry is just too high for competitors. And I think that recent 36% drop is a potential entry point before the 2026 revenue from Asage really starts to kick in.
So what's the strategy here? Is this a buy and hold or more of a trade?
I'd look at it as a swing trade leading into those Q1 earnings. Ride the momentum. But if those contracts execute and the earnings really start to turn, this has the potential to be a multi-year hold.
So vie for the swing, maybe stay for the long haul if it works out.
That's a great way to put it.
I like it. A 7 out of 10. High risk, but the potential reward is clearly there.
The pieces are in place. Now it's all about execution.
Before we go, I just want to leave our listeners with one final thought. We spend so much time looking at the numbers on a screen, EPS, margins, the chart. But think about the reality of what this company actually does. If Big Bear's tech becomes the standard for how the U.S. government makes critical decisions, if the DoD relies on their AI to navigate a crisis, does the short-term stock price even matter compared to the strategic dependency the government will have on them?
Once you become essential to national security, you become infrastructure. You tend to stick around.
Exactly. Sometimes the strategic value is the most important number of all. Something to think about.
Indeed.
That's all for today's deep dive into BigBear.ai. If you enjoyed the analysis, make sure to hit that like button and subscribe. We'll see you in the next one.
Thanks for listening.